Disclaimer. Stock trading is inherently risky and the users agree to assume complete and full responsibility for the outcomes of all trading decisions that they make, including but not limited to loss of capital. Matthew, chapter 25 verse 14-30, For it will be like a man going on a journey, who called his servants and entrusted to them his property. To one he gave 5 talents, to another 2, to another 1, to each according to his ability. Then he went away. He who had received the 5 talents went at once and traded with them, and he made 5 talents more. So also he who had the 2 talents made 2 talents more. But he who had received the 1 talent went and dug in the ground and hid his master's money. For today's video, we are going to talk about learning who you're up against in the market. Each person or organization involved in the global financial system has their own unique goals and traits. Since trading is a zero-sum game, it's crucial to understand the opposing party's motivations before entering into any deals. Let's have a look at the different market participants and how they may affect your trading strategies. Most traders are speculators since everyone wants to earn money. Since exchanges began, speculators have provided liquidity and kept markets in line by selling when prices are too high or purchasing when prices are too low. Technology and lower trading expenses have made retail traders the most prevalent speculators. Retail traders have an edge over other market players. The small trader advantage discusses this. A hedge is a financial transaction entered into to protect against loss due to a change in the value of an underlying asset. Hedge trades may be as simple as purchasing or selling the same amount of delta exposure in a given transaction, or they can include more complex methods like buying and selling linked assets or trading other derivative products like options. In order to profit from the spread without taking a particular side, makers post liquidity on both sides of the market. While some markets have market makers whose goal it is to maintain a constant flow of liquidity, others have market makers who behave more like speculators and shut down their order books if the market experiences significant swings. Financial institutions, for example, engage in massive trading activities across a wide variety of asset types. Central banks are one example of an entity that is not always motivated by profit. They serve no one but are instead tasked with maintaining order in the financial markets under their control via the use of monetary policy. Although their primary motivation is not financial gain, because to their size their activities may have significant effects on the financial markets. Investment banks are another significant for-profit bank. They take directed trades and give answers and intermediaries in complicated deals like IPOs and firm acquisitions. They might execute trades or advise large corporate investors like pension funds. Proprietary trading businesses, commonly referred to as prop firms, are simply groupings of traders who attempt to actively benefit from market changes. These organizations are another example, albeit significantly smaller than the previously listed ones, of an institution. High-volume traders get broker discounts. They may also have access to huge institution research. Price risk is hedged via futures. Buy-side hedgers fear rising commodity prices. Merchandisers buy and sell commodities, while sell-side hedgers worry about falling prices. Hedgers define risk as the asset's purchase and sale price. No market exists alone. Market makers and speculators rule. Speculators may trade futures easily due to leverage. Micro-futures products let retail traders trade futures. Market makers embrace futures for similar reasons. Due to expiries, markets, and buy-side demand, futures market making is profitable. Unlike futures, the stock market has more long-term investors who may only rebalance every 3 to 12 months. Their time spans might alter the stock's order flow. These investors, a subset of speculators, will also prioritize basic variables like earnings releases and economic circumstances. Unlike other markets, stock market market makers must always supply liquidity. Retail traders, known as HODLERs, dominate the crypto market. Since the area is the newest in financial markets, this is anticipated. As more institutions join the market, the few whales have less power. Since crypto is unregulated, market makers don't have to supply liquidity. The exchange may provide liquidity or wash trade itself. In conclusion, trading strategies must include market players and their goals. Since financial markets are zero-sum games, every transaction has a buyer and a seller. If you don't know why someone would accept the opposite side of your transaction, you're missing a significant element. Players include speculators, hedgers, market makers, and institutions. Market participants have numerous subclasses. But this structure might help you imagine your commercial partners.
That's all. Thank you for watching. I hope you learned many new things about the stock market. Kindly subscribe to our channel and click the notification bell. Also follow us on our Facebook page to learn more about the stock market.